Okay, so there's some things that you need to know if you're going to leave your high tax country or even relinquish your U.S. citizenship and maybe move to a pure tax saving country or be in a territorial tax system country or even a non-dom country where you can control your taxes and literally almost get your taxes to zero. But what a lot of people don't understand is when they move to these places, they do stupid things that what happens is ends up coming back and it hits them on huge tax bills to where they would pay actually more taxes than if they just stayed where they were at. Let me go through these pitfalls that people go through, and this is when they literally take the big plunge and either relocate, relinquish their U.S. citizenship, or whatever's needed to get around high taxes legally. Now, what you actually should know about U.S. estate and income tax for foreign investors, there was a good article that came out, Walter Condon, and it was talking about the biggest mistakes, and we've had quite a few videos on this, that people make when they actually relinquish and they get out of their U.S. citizenship or they de-tax themselves by moving from that high tax country and they get out, but they just make some mistakes. Now, there are many reasons for foreign investors to hold investment accounts in the United States with its long history of property rights, efficient and regulated capital markets, and plenty of affordable investment options. The U.S. consistently ranks as one of the best global destinations for wealthy international investors. And you have to agree with that because the U.S. has so many millionaires. It doesn't have, it's actually nowhere near the top as far as the number of millionaires or billionaires per capita. But there are quite a few millionaires there in the U.S. Now China's overtaken the U.S. Now, as attractive as the U.S. may seem, foreign investors also need to be aware of potential pitfalls. And I'm going to be going over some of those pitfalls in talking about this today. And I'm going to be focused on investments in financial assets such as portfolios of stocks and bonds through U.S. institutions as opposed to real estate. Now, there is a difference. Now, in principle, the U.S. is wide open to foreign investors, and there are no laws, whether federal or state, preventing foreign nationals from holding investment accounts. However, for various reasons, complexity and risk and other things, many brokerage firms, banks, and financial advisors, they choose to limit their services to the U.S. residents or at least apply have restrictions on services to non-U.S. clients, such as minimum asset size requirements. So in finding the right investor partners already requires some checking and, with the U.S. investment landscape. I'm going to tell you this, once you leave the U.S., if you're a U.S. citizen or resident, and then you try to keep your bank account or your brokerage account, actually it's easier to keep a bank account than a brokerage account. But where you're going to find out is once you become a non-resident and a non-U.S. citizen, most institutions in the U.S. will not take your business, okay? There are a few in there, but most of them won't. It's getting a lot harder. There are a few brokerage companies that are big ones that still take non-U.S. persons if it's a U.S. brokerage company. Now, let me just tell you some of the things that you're going to run into and some of the pitfalls dealing with estate taxes, okay? Now, the U.S. estate tax for non-Americans. So let's say you've relinquished your U.S. citizenship and you're no longer in the U.S. My first thing I would tell you is to get your U.S. assets out. Not just you leave and relinquish, but you would need to get your assets out. Otherwise, you're going to run into some problems. Now, once you found the right provider, your next concern should be the U.S. estate tax. Now, foreigners are only subject to U.S. estate tax on U.S. assets, but in most cases, they only benefit from a measly $60,000 U.S. dollar exemption compared to a U.S. dollar. They say 12,000. When this article came out, they got here. I said 12,000. It's 12 million and $60, but that has gone up. It's over 13 million now. But just for purposes for the article, they put 12 million. But that's a huge difference between 60,000 and now up to this point, it's over 13 million. So that is a disadvantage once you relinquish. If you do not pull your money out, you're going to be heavily taxed on it if you don't get it outside the U.S. So that measly 60,000 exemption compared to that 13 million today, I mean, to me, it doesn't make sense. You would need to get your assets out. Therefore, if a foreign account holder dies with investments in U.S. stocks worth, let's say, $1 million, the potential U.S. estate tax liability would be U.S. $376,000, corresponding to a tax rate around 40% on assets in excess of the $60,000. Now, as scary as the outcome may seem, it's entirely avoidable. Okay, and investing in non-U.S. Assets. Now, one of the simplest ways to avoid this is not to invest in assets that are not subject to the estate tax, which can be done even in the U.S. investment account. For example, investments in non-U.S. exchange-traded funds or mutual funds such as UCITS funds registered in Ireland or Luxembourg or are not considered U.S. citizens and are not subject to U.S. estate tax upon the death of the non-resident owner. Now, likewise, this is a good point right here. Likewise, ADRs of foreign companies, like Brazilian stocks that are bought in the New York Stock Exchange, for instance, even if traded on the New York Stock Exchange, would not be subject to the U.S. estate tax. More surprisingly, publicly traded bonds are also not deemed to be located in the U.S. for the purpose of estate tax assessment, meaning that U.S. Treasury bonds, possibly the most American of all American assets, would not be subject to the owner to the U.S. estate tax. So that's something you ought to consider. Now, creating a corporate or trust structure, this is another way you can avoid it. Okay, now with some careful planning, it is possible to design investment portfolios that avoid the pitfall of U.S. estate tax, even if held at a U.S. institution. If this option isn't available, another strategy may involve the creation of some form of corporate or trust structure to hold investments. For example, many foreign nationals will choose to open their U.S. accounts in the name of an offshore investment company. Once in place, the company can invest in a U.S. assets such as U.S. stocks. If the owner of the offshore company dies, owner can be transferred to the heirs without subjecting their estate to U.S. taxes. So that's another advantage of having an offshore corporation. Now, the general principle at work here is that while the underlying investments may be in the U.S. shares, the company itself is a foreign entity and therefore not a U.S. citizen. So this is something you ought to consider. Now, while these types of structures aren't necessarily cumbersome to create, they do require careful consideration and planning, so investors should consult their legal counsel to ensure proper procedures are followed. Now, estate tax treaties with the U.S. Now, let's talk about this. With all that said, there may be a need for clever portfolio construction or for sophisticated corporate structure if you happen to live in one of the 15 countries to have signed a bilateral estate tax treaty with the U.S. In many cases, such treaties will allow countries of the foreign nation to claim a larger U.S. estate tax exemption than the default U.S. dollar $60,000, or depending on the actual specific treaty, may otherwise limit the scope of the U.S. estate tax to very specific assets such as immovable property. Now, foreign countries with estate tax treaties are Australia, Austria, Canada, Denmark, Finland, France, Germany, Greece, Ireland, Italy, Japan, Netherlands, South Africa, Switzerland, and the United Kingdom. Now, there are two on here that are really good, and they are Ireland and Switzerland. And let me tell you why, especially Ireland. Ireland has a non-dom program. So you can live there and have this tax treaty benefit, okay, in place. But if you don't remit the money in Ireland, you don't have to pay taxes on it. So you could get paid the dividend, but not remit the dividend to yourself. okay, in Ireland, and you can control your taxes that way. Now, most of these countries on this tax treaty list, the problem with them, the reason they're given a benefit on the treaty benefit is because that other country is going to pay, you'll probably pay more in taxes than you would in the U.S., okay? That's why they've got that. But Ireland is an exception. But you're going to have to put up with the weather too, because Ireland is a pretty nasty place to live as far as the weather goes. Now, the U.S. income tax for foreign investors. Now, what about income tax? Unlike U.S. investors, foreigners who hold U.S. accounts do not have to file with the IRS every year. Instead, they are subject to withholding at source on the U.S. investment income they collect in the form of dividends. The default rate of withholding is 30%, but once again, with a bit of planning and know-how, the outcome can be mitigated. To start with, depending on where you live, the 30% at source withholding on U.S. dividends may not be much of an issue. Since many countries have a higher tax rate than 30%, many investors will be able to claim a credit on their local tax return and simply pay the difference. In this case, the U.S. withholding will not result in any net increase in the investor's tax liability. Now, I can tell you something that will help you even better that's not even in here, and that is pick stocks that don't issue dividends. Now, some of the ones in the past that didn't, you have to watch them. Facebook didn't used to issue dividends. They do now. Alibaba didn't used to. Of course, Alibaba would be an ADR, so you won't have to worry about that. But if you're just trying to get around the income tax itself, buy equities that don't issue dividends, and then you don't have the withholding tax to begin with. But again, Alibaba wouldn't make a difference anyway, because whether you bought it in the U.S. or in Hong Kong, if you bought it in the U.S. as an ADR, so it wouldn't be subject to the estate tax, but you would have a withholding tax on that. Now, the U.S. currently has 58 such treaties with foreign countries, many of which provide reduced withholding tax rates on dividends. For example, an investor from Norway may avail themselves of a 15% tax instead of the standard 30% by making a claim under Article 8.2 of the USA-Norway Income Tax Treaty. The procedure for making the claim is fairly simple and involves completing Section 2 of Form W8 and 8N and submitting it to the institution holding your account. Now, finally, as was the case with the estate tax, income tax withholding can be avoided by simply not holding U.S. assets, which I mentioned to you before, as far as ADRs go. Now, an investor could select funds or shares specifically incorporated in foreign jurisdictions and hold them through a U.S. account. A portfolio composed, for example, of exchange-traded funds listed on the London Exchange may enjoy the dual benefit of avoiding exposure to both U.S. estate tax and U.S. income tax withholding. The various tax withholdings may take place within the fund itself, and this is this would be dispensing on the underlying investments. Now, the key, folks, is just you need to, and I'm not giving this to you as tax advice. You need to get with your tax advisor on this and discuss this with him. But these are things that you need to be thinking about, especially if you've already relinquished your U.S. citizenship or you've already left that high tax country and you're going back into markets, not just the U.S. market with this. You have other markets that have these same sort of treaties, and they might also have estate tax problems too. So you have to look at that. If you want to know more of this, again, how to illegally get around high income taxes, how to get a second passport, as quick as 4 to 8 months, do 3 things. Hit the subscribe button on the right of your screen right here. You'll get new videos automatically as they come out. Number 2 is I would like to hear from you. If you got a question or comment, put it below. And number 3 is go to our website, www.citizenshipquickly.com, and just ask for some help. And I look forward to talking to you on the next video. Take care.